All right, so we're diving deep into One Up on Wall Street by Peter Lynch, the Wall Street legend.
Yeah, this book, it's like a masterclass in plain English.
Totally, and we all could use a little masterclass when it comes to investing, right? But he doesn't pull any punches. He actually calls professional investing an oxymoron.
It's so true. And that's coming from a guy who lived and breathed Wall Street. I think what he means is sometimes those big firms, they get stuck in their ways chasing the same old
It's
things.
like they're trying to turn a cruise ship around, right?
Mhm.
We as individual investors, we're in a speedboat. We can zip around and be way more agile.
Exactly. And that's where that everyday edge comes in. You don't need some fancy finance degree to spot a winning company.
Right. Like that fireman, he saw the potential in La Quinta Motor Inns way before Wall Street caught on.
Exactly. He was like, hey, these guys are popping up everywhere. Clean rooms, good prices, I'm in. He got the business just from observing it in his daily life. That's powerful stuff.
It's like when I see a line down the block for that new taco place. I'm like, okay, maybe there's an investment opportunity here.
See, you get it. Lynch wants us to pay attention, trust our instincts.
So are we saying forget about those big established companies?
Not necessarily. Lynch calls those stalwarts. They're like the anchors of your portfolio, right? Solid, dependable, but
But they're not going to triple your money overnight.
right. They're too big for that kind of explosive growth. It's like trying to race a school bus against a sports car. The sports car, that's your fast-growing company, your potential 10-bagger.
Makes sense. You're looking for the next Amazon, not the next. Well,
Exactly. And that's why Lynch stresses tuning out all that Wall Street noise, the daily stock market drama. Irrelevant. What matters is understanding the company's story, their financials, their potential for growth. That's how you cut through the clutter.
So a good story backed by solid numbers, that's the Lynch formula.
You got it. Focus on the fundamentals, ignore the noise. That's how you win in the long run.
Okay, but how do we even begin to find these companies with these fantastic stories?
Yeah.
Should we be wandering the mall with our notepad?
You know what? That's not a bad idea, actually. Lynch gives us this framework, though. He breaks stocks down
Wow.
into 6 categories.
Nice.
Stalwarts, slow growers, fast growers,
Right.
cyclicals, turnarounds, and asset plays. It's like, think of those as your investing buckets, basically.
Okay, so stalwarts, those are our Coca-Colas, the blue chips, the ones that have been around forever.
Exactly. Slow growers, they're steady, not super exciting, but they're chugging along.
Right.
And then your fast growers, those are the ones with the potential to, really take off.
Those are the exciting ones, the ones that keep you up at night.
Exactly. And then you've got your cyclicals. Now, these companies, they're like a roller coaster, up and down with the economy. So,
Oh, okay.
like, car manufacturers, right? Economy's booming, people buy new cars, economy tanks.
Nobody's buying.
Nobody's buying. Then you got turnarounds. These are companies that, they've had a rough patch.
Coming back from the brink.
Exactly. They're risky, but if you can catch them on the upswing, big rewards.
Lynch did well with Chrysler, right? Wasn't that a turnaround story?
Huge turnaround. He knew when to spot a comeback. And lastly, we've got the asset plays. These are companies sitting on, like, hidden treasures that the market's not even factoring in.
Like what? Give me an example.
All right, so imagine a company, they make, I don't know, office supplies, kind of boring, right?
Right.
But what nobody realizes is they own a ton of real estate, like prime locations.
Oh, wow.
And that real estate is worth way more than anyone thinks. That's a hidden asset.
So you're not just buying the company, you're buying that land too.
Exactly. Lynch teaches you how to spot those hidden gems. Now, once you've got your categories straight, you got to look at those famous numbers.
Okay, let's break that down. Famous numbers. What are we talking about here?
These are the key financial metrics that tell you if the company's story, if it actually adds up.
We're talking about the PE ratio, right? What else?
PE ratio, super important. Cash position, debt levels, you got to look under the hood, make sure the engine's in good shape.
So don't just fall in love with the company because of its story. Make sure the numbers back it up.
Exactly. You got to be able to read the story the numbers are telling. Let's start with that PE ratio. It's basically like a measure of how much you're paying for every dollar of earnings.
Okay.
High PE ratio could mean the stock is like overhyped. Low PE ratio could be a bargain, but also
Or it could mean trouble.
could mean trouble. Maybe the market knows something you don't. It's all relative, Got to look at the company's growth potential, the industry, everything.
So context is key. Now, I remember Lynch really liked companies with a lot of cash on hand.
Oh, absolutely. Cash is king, right? Like, remember we talked about Ford? They had what, like $8 billion in cash?
Yeah, a ton of cash.
That's a safety net. Means they can weather a storm, make investments. They've got options.
Like having that emergency fund gives you peace of mind.
Exactly. On the other hand, too much debt, that's a whole different story.
Especially for those cyclical companies. If the economy dips, they could be in trouble.
Oh, absolutely. Debt can sink a company faster than anything. Lynch was very wary of companies with a ton of debt. He always analyzed their debt structure very carefully. You got to know what you're getting into.
So we've talked about cash and debt, but what about those hidden assets Lynch talks about? Those always seemed a little, I don't know.
Yeah, they're like hidden treasures on the balance sheet.
Okay, I like that.
It could be anything, really. Real estate, patents, even a brand name that's worth more than people realize.
So we got to be like detectives looking for clues.
Exactly. Like maybe you're looking at a company that makes, I don't know, candles.
Okay,
And everyone's focused on the candles, but you realize, hey, they own all these factories, right, where everyone wants to build condos now.
prime real estate.
Exactly. That real estate, it's worth a fortune, but the market's not even factoring it in. That's a hidden asset.
That's fascinating. It's like buying a house for the furniture, but then realizing the house is worth $1 million.
There you go. You're getting it. Okay, so we've talked about finding these companies, but knowing when to sell is important too, right?
Oh, absolutely. That's the hard part. When do you cash out?
It's a balance. Holding on too long or selling too early, both can hurt you.
It's like you don't want to leave the party early, but you also don't want to be the last one there.
Exactly. And Lynch, he learned this the hard way, actually. He tells a story about Polaroid.
Oh, yeah, what happened there?
He held on to Polaroid way too long, even when it was clear they were losing ground. It was a tough lesson, even for a pro like him.
So how do we know when it's time to cut our losses or when to take our profits?
Lynch gives us some warning signs to watch out for. Declining earnings, that's a big one. If profits start shrinking, could be a red flag.
Okay, makes sense.
Change in management, that's another one. Especially if the new CEO, if they don't inspire confidence.
You got to believe in the leadership.
Absolutely. And then keep an eye on the competition. If a company can't keep up, it's in trouble.
It's a jungle out there.
And lastly, always pay attention to the overall industry. What worked 5 years ago might not work today.
So you got to stay adaptable. You got to be ready to pivot.
Exactly. The market's constantly changing. You got to change with it.
It's like that saying, what is it? The only constant is change. But how do you deal with that emotional attachment to a stock? Sometimes it's hard to let go, even when you know you should.
That's why you got to stay objective. Don't let your emotions make your decisions for you. If you see those warning signs, it's time to reevaluate, even if it's a company you love.
That's like breaking up with someone. Sometimes it's for the best, even if it hurts.
Exactly. Look, Lynch, he's all about the long game. Ignore the day-to-day noise, focus on the companies with strong fundamentals, and the market will reward you over time.
Patience is key.
Absolutely. And to weather those inevitable ups and downs, diversify, diversify, diversify.
Don't put all your eggs in one basket.
Exactly. Spread your investments around, different categories, different industries. That way, if one area takes a hit, you're not wiped out.
It's all about managing that risk, right?
Exactly. You want to give yourself the best chance to succeed over the long term. That's the Lynch approach.
So to wrap things up, if our listeners are going to take away one thing from our deep dive into Peter Lynch, what should it be?
I think the biggest thing is believe in yourself. You don't need to be a Wall Street genius to be a successful investor. Use your experience, trust your gut, do your research, and remember, the best investors are the ones who are always learning, always adapting, always looking for that next great opportunity.
Beautifully said. It's not about beating the market. It's about understanding it. It's about finding those companies with great stories and holding on for the ride.
Exactly. And hey, you never know. You might just uncover some hidden gems along the way.
That's all the time we have for today. Thanks for tuning in.